to go.
All right. So it is 12:04. I'll call the meeting to order and we'll do a roll call vote, please.
Mayor Alorza? Can you hear us, Mayor?
Yes. Can you hear me?
Yep. Mayor Alorza? We can't hear you. No.
Okay. You can't hear anything that I'm saying?
Yeah, I hear you.
Okay, now we can. Now we can.
Clear.
Mayor Alorza?
Present.
Vice Chairman Lombardi? Jimmy, you're muted. Jimmy, you're muted. Councilman Igliozzi is absent. Ms. Silveria?
Present.
Mr. Costello?
Here.
Mr. Hirsch?
Present.
Mr. Winkleman?
Present.
We have 5 present and 1 absent. We have a quorum.
I saw Jim Lombardi go on and off, so he might be
I'm here right now, but I'm having problems. I'm going to sign off and sign back in.
Okay, we'll put you on the roll that you're present. Okay, thank you, Jim.
All right. Well, thank you everybody for being here and for always lending your time and your expertise to this important work. And Happy New Year. This is the first time that we're getting together in 2021, so it's great to be here with you all today. So Sherry, I'm looking through the materials that were provided to me. I have the flash reports and I have this article about investing in a bubble, but I don't have a copy of the agenda for today. So I will need some help. I know that typically the first thing on the agenda is a investment performance analysis by Eric. I'm assuming that's the same thing on here today. So I'll hand it over to Eric for item number 1, the investment performance analysis.
Thank you, Mayor. I will start by asking everyone to turn to page 1, as we always do, for your flash report, your update.
Harry, will you be able to put that report on the screen for everybody rather than having to flip back and forth?
The share thing,
Yeah.
yeah.
I have it here. If you allow me to share, I can do it.
Yeah, okay, hold on. Mr. Costello, hold on 1 second. So I have to, so I'll make you a co-host so you can share the screen, okay? Did you get that, Mr. Costello?
Yep, got it.
He's gonna share the screen, okay. Thank you.
Great, thank you.
Okay to continue?
Yeah?
Okay. So if you look at your flash, you'll see that the rally that we've been speaking about in recent meetings continues strongly through January 22nd. The fund is up another 2%, just about, almost 1.9+% year to date. You'll notice that equity is doing very well, and in particular, in recent weeks, the last 2 or 3 months, we have seen value and small and mid cap come back and make up a good amount of ground, although still not all of it, against large cap growth. So they've been performing very strongly lately. You can see, the small cap up between 6 or 7 and 10% year to date in just a few weeks. That's very strong. The large cap is also up nicely, of course. Momentum is up nicely. You can see at that point up 5.8% year to date. So that rally continues. The markets have been, were pleased with the stimulus that was passed in December, $900 billion. That was very helpful. It contained extended unemployment benefits. It contained direct checks of $600. It contained a lot of money for vaccination or virus mitigation, PPE, et cetera. There was additional PPP or forgivable loan program inside of that large bill. And there is more stimulus that is attempting to be passed right now by Congress and the new president. And the market is anxiously anticipating that. It probably won't be 1.9 trillion, but something will be done one way or the other. It's not as big as a rush right now for the market like it was back in December, because the winter was coming, of course, and it was tough with respect to coronavirus and cases and lockdowns and restrictions for economic activity. But now that has passed, and those stimulus checks are being distributed, and the unemployment benefits are being distributed, and PPE as well, and that's helping, and should continue to help for the next several months at least. And in that time, markets are expecting, maybe not right away, but there will be some additional stimulus where money goes to state and local municipalities, perhaps more stimulus, direct stimulus money to individuals, even more extension of enhanced unemployment benefits, et cetera. So markets very happy with that. They're very happy with continued very aggressive accommodation from the Fed. That was reinforced yesterday. Interest rates are rock bottom right now, and the balance sheet of the Fed is increasing rapidly. That is affecting financial asset values, and is somewhat responsible as contributing to the rally. And of course, the vaccines are now being distributed. We're up over probably 1 million a day right now. Started quite slowly, but it's picked up nicely here in the last week or two or three. So markets are looking through this winter's terrible numbers and predicting strong earnings growth and strong economic growth and activity this year. I happen to agree. I think the economy is going to grow surprisingly strongly this year. We just got our data for the fourth quarter, which was weak, of course, but still grew at a 4% annual rate, which in under normal conditions would be extremely strong. But of course, in the up and down of the pandemic, that was actually, quite muted compared to the 33% growth that we had in the third quarter. But it looks like markets are pricing in good numbers for this year, and that is responsible for the rallies that you see in your equities. You may notice that interest rates have gone up, and you see it in your bond exposure, whether it's Loomis down 20 basis points year to date, or the intermediate treasuries down 50 basis points year to date. So rates have gone up a little, and that's a good sign. That's a sign that the markets are expecting some reflation and something of a return in the direction of normal. Still extremely low, however, so I want to make sure we keep that in perspective. The 10-year is still only right around 1% right now, for example. So still half the level of rates prior to the pandemic. So we have a long way to go. There's a lot of people are still out of work. There's a lot of pent-up demand. And there's a lot of volatility in markets because of all of these things. And you've seen it, you've witnessed it, and I expect it to continue going forward. But so far, things have gone quite well for the plan overall. Again, up almost 2% at this time, and well positioned if things do continue to improve. And of course, we see the value in the small cap sectors, small and mid cap sectors, even international, returning and rallying very strongly in recent weeks and months, and that's good news too. Now, Mr. Hirsch, you kindly helped us pass along an article with respect to this phenomenon on the growth value issue and potential bubble issue, et cetera. That was also passed along to the participants. A very interesting and timely article on some data, et cetera. Would you like to discuss it a little bit, or have me talk about it, or which,
I know,
which would you prefer?
I think the article speaks for itself, so just puts a little different perspective on where we are.
Before we move away from the portfolio, Eric, can you talk a little bit about Renaissance? Obviously, they had a tough year last year. They're off to a tough start this year, and it's almost our largest holding on the equity side, or the growth side, you want to call it that.
Yes, thank you. I'd be happy to. Renaissance is a long-short manager, a quantitative manager. They're called quants for short. One of the biggest in the world, one of the longest track records with the very strongest track record. However, that's correct. They're our biggest drag in recent times. Most quant managers, that's what their sector, their strategy. There are others in that strategy, of course. They've been struggling with the volatility associated with the pandemic and very large fiscal stimulus and monetary stimulus. Some of the traditional quantitative behavior, or they call them signals, some of the traditional signals that they usually zero in on with their exposure and their strategy have been going in the opposite direction, and it's been hurting them and holding back our portfolio as well. I've seen this happen before. It happened coming out, strangely enough, or interestingly enough, coming out of the great financial crisis, when markets rallied extremely strongly in 2009 into 10. For example, they lost money then too. They were well negative while the market was rallying extremely strongly. So seems to be that can happen from time to time in this sector, but it is certainly a well-known market phenomenon in recent quarters that the quant sector has been struggling. We discussed this a couple of meetings ago when we went over their impact on the portfolio, and it's been basically the same. They had a good December, yes, but they're down again here in January. So we're sort of in the same environment for the long-short quant managers at this time.
Eric, with regard to that, though, one of the things I find disturbing is their employee fund, which is a sub of Renaissance, did pretty well. Did you do any research there? Do you have any information regarding why their internal fund that are for only employees did better than their flagship fund, which were in Renaissance?
Yes, so I know the fund well. No outside investors are allowed in that fund any longer. However, over 15 years ago, maybe over 20 years ago now, we used to have investors in that fund, and this subsequently closed. It's called Medallion. It's called the Medallion Fund, and it's a different strategy. The Medallion Fund is a very high frequency trader. Sometimes they hold their securities for minutes or hours or days. So it's quite a different strategy, whereas the Institutional Equities Fund, the REIT fund, is designed for institutions, and the holding period is often a year or longer, and has much less leverage. Doesn't use anywhere near the leverage that Medallion does, and has a much lower frequency of trade, or meaning a much longer holding period. So there are some substantial differences between the strategies, but Medallion Fund is widely regarded as probably the very best hedge fund in the world, period. Their numbers are better than anybody else's I've ever seen, but it has not been available to outside investors for a very long time. And that is because they cannot manage a lot of assets in that strategy compared to the other strategies. So they closed it out many years ago. It's just because of the nature of and the frequency of the trading, It's not possible to manage large quantities of money, and therefore that's why there are no outside investors in that fund.
Eric, can you just help me understand, sticking on Renaissance? So, you know, their performance, how much of that is a function of strategy versus results, or rather execution on the strategy? So you had mentioned that they also did poorly during a previous economic recovery. So is their strategy one that you would expect that in a time like this, they would be underperforming, or is that not their strategy and it's just that they're making the wrong calls?
I wouldn't say I would expect it. I would just say I'm not surprised by it because it has happened before, because of the nature of what they do. They go both long and short based on their computer or quantitative signals. And there are times when it just this doesn't work. But in most years it does work. And so it's not very predictable. It's just not surprising that it does happen from time to time. This is the first time over the last year or so that it happened since then. There are years when markets are down and they make money, or when markets are up a little and they're up a lot, or vice versa. It's quite weakly correlated. That's another way of saying the correlation is low to markets, usually runs about 0.4 for those of you who follow that stuff. And their beta is usually low, and they usually have a much lower standard deviation, or noticeably lower standard deviation or risk than the market. But this does come with the territory, and it can happen to quantitative managers. It has happened before, and it will probably happen again in the future as well. The execution, to answer your question, seems to be the same. We've done a lot of, there's been conference calls and letters and research provided. But basically what I've been saying is that the signals that they have used for year after year after year, and they do modify them routinely, but the general signal process that they generate in their strategy has not been working lately, for sure. And it's not been working for most other quantitative managers who do a similar strategy. They've also been...
excuse me, Eric, I hate to interrupt, but I beg to differ with you. The benchmark for long-short strategy for 1 year was plus 14.4%. They're negative.
Okay, that's long short. That's many different kinds of long short.
Yes.
But if you look at quantitative managers, computer modeling managers, that's what I was referring to, which is what Renaissance is. There's many, many different kinds of long short equity managers, various amounts of leverage, various concentration, sector focused, broadly focused, fundamentalists, macro driven long short equity managers. That's a pretty big bucket. So the hedge fund industry as a whole did have a pretty good year last year. And the fundamental guys actually did the best.
I'm talking specifically about long short, which includes everything you said, and which is the benchmark for Renaissance. They underperformed by almost 33 points for the year. That's big.
That is true. If you look, I got to get the page. One moment, please. It's a big document. There it is. Yes. So they did underperform. But for example, against the same benchmark, if you look over 10 years, they're up 12.4% per year, and the benchmark is up 5.3. So over a 10-year period, outperforming by 710 basis points per year, and since inception, over 400 basis points. So it's mostly driven, of course, this number, it's all of their underperformances in recent 3 years, for example, is driven by last year. But the long-term numbers have massively outperformed the long-short benchmark. Although clearly recently they have underperformed, by a wide margin.
So Eric, at what point do we stop focusing on the returns from 6 to 10 years ago, and we're more focused on the short run? And is there a process where Wainwright puts people on watch lists where you
Yes.
look to adjust positions?
There is. It's concentrated in the last 12 months or so. If you looked at before then, they continue to outperform. So the underperformance has been concentrated in the last, sort of year to two for sure. So how long is enough before you worry about them? One of the things that we do is we look at what some of the other quantitative managers are doing. So one of the other big ones is AQR. They had a terrible year as well. We should certainly put them on a watch list or soon put them on a watch list. So far, if you're looking for insight from us, we've actually been adding exposure in recent months to the fund for other clients as a way, if that helps to illustrate what we think about the next 3 or 5 or 10 years for the fund. So at our firm, we have been adding exposure, but clearly, it's a big underperformance. I've seen it before. I'm stuck with the fund, and it turned out to work very well. That's our belief right now. There are, of course, no guarantees, but that would be our advice at this time.
Eric, then what about, and I respect and understand that that's your belief. I want to maybe raise it up a little bit and say, what's your thoughts regarding on a pension like this is to have a 9% exposure to one particular style and manager?
Traditionally, our approach has had that level over. I think we put them in 2005. So for the last 15 years, they've been bouncing around that level. We have a very well diversified portfolio for sure, but we have some managers with, significant exposures, in the, Loomis Sales, for example. That's a bond manager, very different, but that's often, 18% or so or something like that. So it is a very large exposure. There are pros and cons that come with that. Over time, we've thought that has been a value add to make that decision and make that recommendation. It is certainly something the board could consider, is to, have a lower exposure, a lower target rate for a single manager like that, with the implications that would go with that. So greater diversification is something that would be reasonable. We're comfortable with a 9% exposure for the manager, and have been, and do it with other clients as well, because again, they're so highly regarded as one of the very best out there in the world. Now, sometimes great managers become not so great anymore, and that has happened, and it's possible that could happen in this case. We have not concluded that yet, but it is possible. There's no guarantees for sure. We would never want to make that mistake. So the board could consider that. We don't think it would be the end of the world. We're comfortable with where it is. If we weren't, we would come to you and tell you. But a reduction in exposure would be a reasonable thing to consider if that type of volatility and exposure is something that is on the high side for you, and you'd like to consider reducing. We would do that. Although again, at this level, we're comfortable.
So Michael or David, I hear you guys, and I'm looking at their sheet, their performance over the trailing 5 years. It's closer to the benchmark, but everything from the last 3 years on, they significantly underperformed. So I share that concern as well. So I'm looking at page 57 on the sheet. Is there a recommendation? Is there a, I mean, given the level of underperformance for these past 3 years and change, is it your suggestion that we consider lowering or limiting our exposure in this fund?
David, if you want to go.
No, go ahead, Mike.
I mean, I just think it's not ideal for the commission to be advising the consultant. I think at the end of the day, the consultant needs to be the one, you know, living and dying by the recommendations that they're making. And if Eric doesn't want to change this, or I should say Wainwright doesn't want to change this, I think that's their call, but then they've got to live and die by that result. I think if we all had our own opinions and we tried to put our hands too much on it, then Wainwright can step back and say, hey, this wasn't my idea. This is what you wanted us to do.
Mhm.
Yeah.
Yep, I agree.
Yeah, that makes sense. Okay.
Well, I would.
Go ahead, Eric.
Sorry. Sorry, Mayor. What I would say is all of that is true, and thank you for that, and we appreciate that. But also, I would say that our job is to match the risk-return profile to the client's desires. Give our best advice, which we always do. Give our first best recommendation, which we always do. But then with interaction with the boards and making sure that the risk-return profile of the fund itself, of which each manager or exposure is a part, matches what the board is looking for. So we're always willing to take input in that context going forward. And then we give our advice as to what that implies when you adjust the exposure in the portfolio or manager weightings, et cetera, and work with the board to implement their wishes. Again, we are comfortable where it is now, but if the risk return profile of the board is such that, geez, a smaller allocation would make us more comfortable, it would have implications for upside and downside, but it would be a risk return approach that it more closely matches the board, then that's okay too. So it's while we're certainly willing to be responsible for our recommendations, et cetera, we do always, look for input with respect to overall risk tolerance, et cetera.
So the question then, at least from my perspective, is following through on Mike. It is normal times a 10% exposure. It will be higher, obviously, if they perform to one single manager, something that's appropriate in a pension fund. I don't know the answer to that question. You have that from other clients and probably other data that you get, but it would just seem off the cuff to me to be a rather high exposure, unless, of course, it was in an index treasury bond fund or a ladder treasury bond fund. I don't know the answer to that question.
It varies widely. It does. Very, very large funds often have smaller exposures to individual managers simply because the size precludes a bigger exposure. But you see exposures to managers of 2%. You see them 6%, 8%, 12%. The answer to your question often depends on the size of the institution as well.
Yeah, but it's a pension.
But in this case,
a pension's different
sorry,
from a university endowment. It's different than a nonprofit's endowment. It's different than a community foundation. It's a unique animal.
That's true. There's differences in this case. This fund has a very large liquidity need, of course, on a monthly basis. And so that has impacts, of course, as well. This happens to be a very liquid fund, and so that's good. But all of that is taken into consideration when you consider a manager or a strategy and a weighting percentage exposure to that manager or strategy.
I have a question, Eric, Winkleman. I'm looking at the bottom line when all is said and done, 6.4%. How do you think we've done in this environment with this fund? 6.4.
Yes. Because of, I think, given our asset allocation and long-term strategic asset allocation, you did just fine. However, that long-term strategic asset allocation has large exposure to value and to small and mid cap and international, et cetera, which, greatly underperformed large cap growth, which drove the S&P 500, for example, or growth in general. I should say growth in general, but in recent times it has been concentrated in the large cap growth area. So as a strategic asset allocation, knowing what value and growth did and the historic spread in those returns, something we haven't seen really ever, I would say you're within expectations. Most of your return was generated, of course, by the strategic asset allocation, and value very much held back portfolios this year. You can see, for example, if you look up at just at the top of your page, you see the Vanguard Value Index Fund, which is pretty much, very close related to the Russell 1000 value or large value, was up 2.3% year to date, and the 1000 Growth Fund was up 38.4% year to date. I've never seen that before in terms of the spread. So the analysis or the insights to offer to the board is that it's the value growth differential was very determinative in 2020 for institutional portfolios of all kinds as to how well they did, say, relative to the S&P. Bonds had a very good year, and yours did too. It was really the equity movement, the pandemic and the shock, and the movements in rates, et cetera, that affected the growth value differential. That's a global phenomenon, and that is the biggest. So how did we do? I think, given our strategic asset allocation, fine, and within expectations, conditional on that information.
My belief is that we're low. I don't think we did fine. Not in this market. I'll be honest with you.
Sure. I mean, S&P did 18%. So
I understand, and it's all overall. I was looking for my result on my fund, which is on one of my investments, and it's completely automated. And I can't remember what it was, but I think it was like 10 or 11%, completely automated, and a very conservative thing. This is long term.
So I have
That's true.
two suggestions. So Eric, I know that in the past I've seen a document that compares our returns to our peers. Can you put that together for us once again?
Yes, there have been some changes to that index, but we can. Those won't be out for a while, but we could get it to you in maybe not the next meeting, but the meeting after that. It depends on when the service compiles it. But yeah, the answer is yes.
Okay, that's one. And then the second thing is, it strikes me that we're having a great deal of more and more conversations around our general policy and our strategy with the fund as a whole. And I can't remember when we did when we had the last reallocation conversation, but it seems like it was at least a year, if not significantly more than that. It strikes me that it may be time for us to have a reallocation conversation.
Sure, we could do that.
So
you know, you could,
let me,
sorry, go ahead.
that's not necessarily a, let's do this for sure. It's a suggestion that I want to hear from the other commissioners from, whether that makes sense at this time. But Eric, for context, do you know offhand, you know, when was the last time we did a reallocation or thereabouts?
We added some new exposure and reallocated the portfolio. It was probably a year and a half or so ago. Remember when we, for example, we added the momentum and quality and made some changes when we did that. So if I look, I could give you an answer. No, I don't have it. I don't have it with me. It was probably a year and a half to 2 years ago.
Yeah, I remember having a limited conversation. I think it was about adding more passive. I can't remember exactly, but I think the last time we did like a full reallocation conversation was a while ago, even more than a year and a half. But I just want to get some input from the other commissioners and hear whether that makes sense.
Well, regarding allocation, that should be something that's on our to-do list at a minimum annually. Doesn't mean we necessarily have to take steps to change it. We could reaffirm the allocation, but at least minimally, my experience has been endowments do it at least annually.
Yep.
Okay. Yeah, if that's the standard, then we're definitely due.
Yeah.
Okay, so Eric, can you tee up that conversation for our next meeting?
Sure, we could come back with some potential portfolios to look at, some with, you know, an asset allocation discussion with different weightings, et cetera, changing the value growth mix, reducing hedge fund exposure, more fixed income, perhaps, you know, things like that for discussion.
But Eric, I do think you need to really put your stake in the ground and say, this is what Wainwright is advising. And it's not something that you want to get input from 9 different people. You know, so because again, I think ultimately you own the performance. And, you know, I think as Mr. Winkleman pointed out, 6.5% last year, you know, is pretty low.
Well, we'll give you our recommendation for your consideration. You know, we'd be happy to do that. It's easily done, and it's a good practice to do so, and we will do so.
Thank you.
Okay. Any other questions or comments for Eric?
I have a question, but not for Eric.
Okay, go ahead, John.
Page 9, withdrawals and input. And I look at, you know, the contributions are again low by about 10, 20 million. And I noticed the withdrawals increased in the month of December by 5 million. Could somebody enlighten me why all of a sudden there's a $5 million withdrawal?
I can speak to that. That was, we had a settlement agreement with our pension fund, and we owed some retroactive payments to some retirees. So it was about a $5 million expense.
Okay.
Okay.
But like I said, I continue to worry about the fact that the contributions for this year were low.
Right.
Yes. So we're going to look at that at the end of our third quarter tax collections, which is this month. So we will be sending some more money over at the end of this month.
Yeah. Okay, thanks.
All right. Any other questions or comments? All right, I'll entertain a motion to approve the investment performance analysis as just delivered by Wainwright. Is there a motion on the table?
I so move. John
So moved
Winkleman.
by Commissioner Winkleman. Is there a second? Seconded by Commissioner Costello. Any discussion on the motion? All those in favor, please say aye.
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 Are there any opposed? Okay, the ayes have it. The investment performance analysis is accepted. I imagine that matter number 2 on the agenda is the investment performance analysis relative to the Dexter Trust Fund and other accounts.
No, it isn't, Mayor. It's discussion and/or decision relative to Point Judith Venture Fund 2.
Okay, well, we'll move on to matter number 2, as you just mentioned, Sherry. I'll hand it back to Eric.
Thanks, Mayor. Last meeting, we had a discussion about a remaining stub investment, a holding that the city has with related to the Point Judith Capital Fund. The fund is now ended. It ended as of December 31. At the time of their disposition, they had one remaining exposure in a company called Invite Manager.
Oh,
With respect to closing the fund, the manager, Point Judith Capital, has distributed the ownership to the individual LP investors in the fund in this company. So the city has a remaining direct holding in Invite Manager that was valued at $212,000 by Point Judith Capital, and that ownership has been transferred to the city directly at the Invite Manager level. So you have that ownership of that, again, a private company valued by Point Judith Capital at $212,000. At last meeting, we informed the board that Point Judith Capital had arranged for limited partners to discuss with a buyer, which is Blackstone, an entity of Blackstone, to buy these shares from the limited partners, if they so desire, that were in the fund. And the city instructed us to investigate the offer, talk to Blackstone and see what the offer was, and come back and report that for possible sale of the remaining direct positions. We did so, and we've had discussions with them, and there is an offer, and the offer is the same for all investors in the fund. And as far as we know, we've been told over half of the investors have taken that offer, or have indicated that they will take that offer. So the offer is at a discount to the value that was reported by Point Judith Capital, and that offer for that $212,000 position is just under $117,000. So it's about a 45% discount to the value which was assigned to it by Point Judith Capital. Again, we are told that more than half of the investors have indicated they will take that deal. We have also been told by Blackstone that because of the high uptake, that the deal may end, the offer may be ended here relatively soon. And they recommended that we pass along to you that a decision would be necessary in order to guarantee the offer being extended to the city. So we are reporting that offer to the city of just under $117,000, and that would preclude the city from holding a direct investment in a private company. Now, you could hold it. Some investors are going to, and the company may do well, it may do poorly, it may do average. It's been affected, of course, by the pandemic, like many companies. So it's up to you. It is a significant discount, but of course, it's an extremely small number relative to the size of the portfolio. we're talking about 5 or 6 basis points here on the value of the portfolio. Last month, there was some discussion about, why would we hold that? Why would we hold a single stock? But we have investigated the offer, and that's the offer, the discount as described. And if you do decide to take it, we would recommend that you decide today, one way or the other, because the offer may not be there any longer.
What's your recommendation?
Given the size of it and the nature of it, and what the city's traditional approach has been, we would recommend that selling it would be fine. I mean, neither approach would be bad. I don't think there's anything wrong with doing either, but our recommendation would be that you could sell it and focus on the rest of the portfolio.
Can I just mention that I'm recusing myself from the vote and the conversation?
Thank you. Thank you, Michael. Sherry, can you just make sure that the record reflects that?
So noted. I will send him a recusal form.
So thank you. So thank you for that report, Eric. And it just strikes me as odd that it would strike me as odd for a fund this size for us to have holdings in an individual company, and just doesn't strike me as wise as something that we should do. So, I agree with Eric's recommendation, and I also think that we should sell.
I'll move that we sell the security.
Okay.
I agree also.
Great. Motion made by Commissioner Hirsch and seconded by Commissioner Winkleman. Any discussion on that motion?
Call vote, please, Mayor.
Okay, we'll do a roll call vote.
Mayor Alorza,
Aye.
Vice Chairman Lombardi,
I think he's having trouble with connecting. Jimmy, can you hear us? Jimmy, can you hear us? Yeah, he texted me, he's having trouble with his connection, so just.
all right. Councilman Igliozzi, is absent. Ms. Silveria,
Aye.
Mr. Costello has recused himself. Mr. Hirsch,
Aye.
Mr. Winkleman.
Aye.
We have 4 ayes, 1 recusal, 2 absent. The motion passes.
All right. Well, thank you. Thank you, Sherry, for that. The motion carries. We'll move on to matter number 3. And matter number 3 is the Dexter Trust accounts. Is that right, Sherry?
Yes, it is, Mayor.
Okay. Well, I'll hand it to Eric for an investment performance analysis of those trust accounts.
Thank you, Mayor. If you'll turn to your second package that we gave you, the investment performance and review presentation for the Dexter Donation Trust and the others. And then if you were to turn to page 1, you will see what has happened. And so these portfolios are managed very similarly. What they have done, and you can see that for last year, and of course they have much more equity and no hedge funds, no alternatives. The Dexter Donation Fund did 14.2% last year, and this year to date, is up 3.3% so far. So no recommendations for any changes. Those funds, those allocations had a very good year last year, and so far going well again. And the discussions about markets that we had earlier would, of course, apply to these portfolios as well.
Okay. Any questions or comments for Eric? All right. I'll entertain a motion to accept the investment performance analysis for the Dexter Trust Fund and other accounts. Is that a motion, Commissioner Winkleman, or a question?
Motion.
Motion made by Commissioner Winkleman. Is there a second? Seconded by Commissioner Costello. Any discussion on the motion? All right. All those in favor, please say aye.
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 Any opposed? Okay, the ayes have it. The motion carries. Thank you. And Sherry, is the next thing litigation?
Yes, it is, Mayor.
Okay. Ken, is there anything to discuss today?
Nothing to report, Mayor.
Okay, I'll entertain a motion to continue matter number 4 until our next Board of Investment Commissioners meeting. Is there a motion?
So move.
So moved by Commissioner Winkleman. Is there a second?
Second.
Seconded by Commissioner Hirsch. Any discussion on the motion? All those in favor, please say aye.
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 Are there any opposed? All right, the ayes have it. The matter is continued. And adjournment is next.
That is it for the agenda, Mayor.
All right. All right. Well, I hereby declare this meeting is adjourned.
Can I have a
Bye.
motion?
Oh, so,
Hi, everyone.
I'll entertain a motion to adjourn.
so move.
So moved by Commissioner Winkleman. Is there a second?
Second.
Commissioner Hirsch, second. All those in favor of all those in favor of the motion, please say aye.